You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
Welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If we sound a little bit different, it's because we're coming to you from a different location, not from the scenic Options Insider studios in sunny Chicago, but somewhere a little bit scenic, more scenic, I should say, and a little bit sunnier, of course, right outside LA and San Diego for the annual CBOE Risk Management Conference. So we're going to dispense with our usual format this week and going to break down all things CBOE RMC, a lot to get to. And I've assembled a great team to help me do that, starting with directly across from me, my cohort, my partner in crime, soon to be someday in the next 10 years or so, Dr. Vix, Mr. Russell Rhodes, the head of education over there at the CBOE Options Institute. Mr. Rhodes, welcome back to Volatility Views, sir.
I am, as always, very thrilled to be here.
I'm glad to hear it, sir. I'm thrilled to have you here. And next to us is a frequent offender. Haven't had him live in person on the show in a while. He is Bill Luby, manager of Luby Asset Management, as well as, of course, the proprietor of VIX and More. And so if you wanted a little more than just VIX, he's the guy to bring it for you. Bill, welcome back to the show to you as well.
Great to be here. Thanks for having me.
And last up, not last but not least, joining us on the end there is, he was on last year, but it's been a while since we've had him on. He is Ilya Feygin, the managing director over there at Wallachbeth Capital. Ilya, welcome to the program. Do you a favor, just slide a little closer to the mic there. You can even slide that a little closer to you. You guys can just slide it in between. Just lean in. Yeah, lean in. There you go. Ilya, how you doing today, sir?
Good. Thank you for having me.
You just got off the panel, so you're all fired up to talk all things RMC. So let's do that. We're going to kind of do a nice conference overview, a conference rundown. But since you're our guest today, Ilya, and also because you just got off a session, so it's fresh in your mind, why don't you go ahead and give our listeners a bit of an overview of what you were talking about today?
Well, you know, the presentation was focused on edge in options trading, which included probability, trade construction, and various pitfalls and misconceptions in betting strategies as they apply to options. I think that, you know, the first part of the presentation was focused on both the theoretical and the practical problems of betting size, which was addressed by the Kelly criterion. You know, how much of your bankroll do you bet? And this theory grew out of the work of Kelly and Thorpe, and obviously Mr. Thorpe was a keynote speaker here.
He doesn't get his name on it. It's not the Thorpe criterion, though. It's he got pushed aside on that one. I was going to ask him that. Yes, I didn't get a chance.
Just like the Black-Scholes and the American put.
Those academics, they're so naming rights is a big thing.
So the theory was to bet your edge over odds, and it's very known in gambling. The edge is basically the expected value of the bet, and the odds are the payoff ratio. So, the example we had was, you had a coin flip that was 5-1, and the ratio said you had to bet 40% of your capital, and that was a very, very high percentage. And, there was a high risk of drawdown on that trade, and it's basically 4 losses in a row almost ruin you, despite that it's not exactly probability of ruin. And then you see the same thing in the options market. If you buy a vertical spread that's $6 wide and you buy it for $1, it's 5 for 1. Unfortunately, the probability is not always there. And after that, we looked at just practical problems that people face in backtest and common strategies like VIX tail hedging, condors, which failed. Then
I do a lot on failed condors. I think that's been it was the strategy du jour for a long time. It seems like it has fallen off in the last few years for a variety of reasons. Certainly, it's not the sexiest thing right now with vol so in the toilet right now. But you probably could that probably would be an interesting subject of a future presentation. Failed condors. I would sit in for that. Definitely.
And we looked at common strategies to look at what's their actual edge. Is the win-loss ratio really that good, or has it just been a good period where the probability has been good? And that's been the case with buy rights. 80% of the time, the market just hasn't gone down by the premium, and even though the win-loss ratio hasn't been that great. We looked at different ways of adjusting strategies, where if you roll 1 week before, or if you adjust the strike a little bit from 100 to 105, there was huge differences in performance. We looked at a SPY buy right. You came out with a $10 million investment over 5 years, and just moving the strike up 5% in out 3 months, and rolling it 1 week before. I mean, it was the difference of making, I think, 5.8 million or over 8 million in P&L, just minor adjustments.
Pocket change, chump change.
We looked at some of the misconceptions of backtesting, different periods. We looked at some of the trades that do have edge today. We looked at situations where event risk was either things were mispriced, such as into the U.S. election, where you had very high implied correlation. You had people buying the wrong vol. They were buying EFA and SX5E, and they got burned because there were offsetting effects, where you had the currency and the equity offset, and the vol was just dampened, and it had nothing to really do with the center of the event. We talked about Brexit. We talked a little bit about the French election, and we looked at these events not just as risk points where you need to be afraid or you need to hedge, but also things where you can proactively take advantage of this pricing and put on risk. We looked at a trade in EEM where we bought a July call and sold a May put that had very, very nice edge last year. We looked at some ratio spreads and 1x3 by 2 butterflies, just strategies that have had pretty decent edge. We looked at selling a $1 put spread and buying a call, and which was very nice for credit. And there are a lot of interesting trades that are out there that people are missing.
It seems like you could sum up a lot of RMC this year with maybe 2 phrases. One is harvesting risk premium. We'll get to that. I hadn't heard that phrase so often as in the last couple of days as I probably have in the previous 6 months. And the second is what you referred to earlier, the kind of the Kelly criterion, and utilizing that in various different capacities. Of course, we had the speaker, Edward Thorpe. I'm sure Russell will get to that in a minute. One of his many childhood heroes. He got to finally meet this week, as well as risk premium harvesting. So maybe we'll get to that, Mr. Rhodes, if you could slide that over to you. Obviously, this is. Maybe we'll keep it in the middle so that, we don't have to keep sliding it and driving our listeners crazy. But for now, you can slide it over there. But yeah, this is obviously a big week for you. This is, kind of one of your big weeks of the year, shall we say. Everyone's coming in. The whole volatility spectrum is coming to the CBOE to talk all things, the cutting edge, shall we say, of volatility research. So you've been flittering around. I've seen you've been very busy. You've been meeting people, interviewing people, taking notes on sessions. Quick overview. What are your thoughts here on this RMC and some of the interesting trends or presentations or studies that caught your eye?
Sure. Well, like you said, I got to meet my childhood hero. Ed Thorpe. I think one of the reasons that nothing is named after him is because he's so freaking nice. Seriously, it's just I've never met somebody that's done so well in this business that is just a pleasure to be around. And I really wanted to ask him, and I forgot. I wonder if he would rather have a Nobel Prize than the money.
Oh.
I mean, that's the question. That's the question I wanted to ask him. But because he really did come up with Black-Scholes before Black and Scholes came up, or Fisher Black came up with it, and Myron Scholes slapped his name on it. And I would love to know if he, I think he never thought of the academic breakthrough, just thought of making money with it, which I'm sure he's pretty happy with. Yes,
very practical
I'm
approach.
sure he's pretty happy with as well. You know, the constant theme that I heard about, and we all know, I mean, we've been talking about it every Friday for 6 months, and you've been giving me a hard time about it, is how low VIX is. Volatility is not necessarily a buy low, sell high thing. When VIX is around 12, the realized volatility is 5 or 6. You can do pretty well selling options or harvesting volatility risk premium, like you put it. And when we were at Risk Management out in Europe back in the fall, a couple of people said they felt like it was easier to try to take advantage of overpriced options with VIX at 12 than VIX at 20. And I think that may be why you've heard that theme. The other thing that I heard more of than you normally do, not a lot of, but more of, was actually people talking about buying options. We've got that whole phrase that professionals sell volatility and retail buys volatility, or is generally net long options because they've got a directional outlook. Well, you had different individuals talking about how how portfolio protection is so cheap that it's probably cheaper to buy some puts than go to cash right now. And there was one of my favorite comments, and I don't think he wants it to be attributed to him publicly, but one of the portfolio managers that was on a panel actually said that puts are so inexpensive that he's able to have a constant hedge on, and it actually allows him to get more aggressive on the upside. And you can't necessarily quantify that ability to not be too concerned about buying the S&P 500 at the high when you know that you're playing with a net or whatever.
That's
so I liked that as well.
We've talked about before. I think you're right. Yeah. One of the portfolio managers or maybe one of the consultants mentioned that on stage about it frees you up to take risks in other areas, which is, you're right, kind of an unheralded effect. Maybe it's kind of hard to study that, but maybe that is something, maybe for a future RMC, we'll see a little bit of data, probably be more of a survey of fund managers. If you haven't put, what do you do differently, or how do you feel? Do you sleep better at night? Something along those lines. Because there are those kind of intangible benefits that come from being hedged to the downside that probably they can't be factored into the Kelly criterion or other things like that, but they are tangible to a lot of money managers. That's interesting. Any other takeaways that kind of caught your eye right there, Mr.
The first panel discussion this morning was on predictive analytics, and Joe Getz from over at SMA was he's pretty vocal, and he kind of dominated the panel. It's the first time that I've seen a presentation on using Twitter sentiment for trading signals where somebody from the audience has not challenged that theory. And which means I think it's becoming a little bit more widely accepted. For better or worse, it might actually be because the president has, before he was president, I guess even after, I try to ignore his Twitter stream, but he has tweeted things about companies that have resulted in the stocks being impacted very quickly. So, for better or worse, his activity on Twitter that has impacted stock prices may be providing some legitimacy or at least attention to predictive analytics from Twitter data.
I had a chat with Joe about that. I got a chance to meet him for the first time at this conference yesterday at lunch, and I was giving him a little bit of a hard time about that because I said everyone and their mother has been hitting us up over the past 2 months saying it's a new spin on social media analytics, which is the Trump indicator, the Trump analyzer, the Trump flagger, and he took a very, as you might imagine, dim view of that.
And I can understand that because in addition, the way that they run their analytics, they have identified what they consider market influencers, which means I can't go open a new Twitter account and say a bunch of bad stuff about Apple over and over again and mess with their sentiment. I actually need to be established, followed by other influencers. They have a criteria for you to fall within the basket of Twitter streams that they're monitoring. Problem is, when Trump throws something out there about a particular company, it actually does get in there and go haywire on their signal. I'd love to see the data around Boeing. December 6th and different. I might actually ask him for that because when Trump hits an individual company, it takes the volume of tweets way up, even with the retweets, and that's part of the algorithm they use to determine sentiment.
Yeah, I have some data, breaking data on that as we speak. Well, I think we'll get to that in a little bit. I want to get Bill's opinions first. But speaking too with the social media stuff, because I asked him that question as well, because it's often put out there as this is the wisdom of crowds. This is the wisdom of crowds, and he kind of poo-pooed that notion and said it's actually, like you said, it's more they filter it, so it's the wisdom of influencers. So it's not your proverbial grandmother in Iowa who wants to slam Apple or whatever the case may be. It is people who have they try to determine, obviously, that's where some people could maybe like it or dislike it depending on how they filter, but they try to filter it so people who have some sort of impact on the marketplace, and that's kind of what they're working on. I want to get them on our tech show to kind of dig into that a little bit more, so we might do that. Bill, same question for you. Has been a lot kind of going on this week in terms of all sorts of topics of premium harvesting. As Russell mentioned, there were a few people raising their hands and saying maybe you want to buy premium. I did highlight them too. They were kind of a refreshing change of pace, as well as Kelly Criterion and a number of other things. What caught your eye this week at RMC?
Well, the conversation kept coming back to low volatility for me. Maybe that's just me, but a lot of people talking about correlation. And is that correlation the answer? Is it all about realized volatility providing a floor, and you can only go so much higher than realized volatility? But then a lot of conversation about the disconnect between uncertainty, economic policy uncertainty, political uncertainty in Europe, et cetera, and what we're seeing in terms of the VIX, and a lot of people breaking down what's going on in Europe with implied volatility versus what's going on in U.S. I think Ben Bowler gave, for me, what was the presentation, or one of the best presentations of the conference.
Present company excluded, of course.
Present company excluded, of course, where he touched on a very much a global cross-asset class view of the world and talked about the end of the current volatility regime and how that's going to be driven by changes of what's going on in the central bank and central bank constraints that they now have now that inflation is going up, and painted a really interesting picture about how we're likely to be at a volatility inflection point. And that triggered some rare conversations I've had about buying options with people, which is something I can't remember the last time I talked about buying options.
A rare treat at RMC, yes. Or just in general, you're right, these days. People are so focused on harvesting premium and the low levels they're getting right now. You're right. It's you think that would flip the script to them talking about it. And they alluded to it a little bit at on Scott Madel's panel this morning, a little bit about that at the front. You can tell he was a little tentative to do a deep dive into maybe buying weeklies, but maybe I'll ask him about that for a future study of timed buying of weeklies and how that might play out. But anything else catching your eye?
There was one thing that was, to me, surprisingly persistent, and that was the question of how much capacity is there in SPX options. And I was actually surprised that came up as a question. And of course, we've had an opportunity to test this in various crises. But I guess the specific concern started about if institutions are starting to get more traction in the buy right strategies and put right strategies, will this start to put some stress on the market, and how much stress can it hold? And I think Manish, Deshpande, that's probably his last name. I always mispronounce it. Who always has a great presentation.
Yeah, he's one of my. I usually make time for his.
He is one of the go-to presenters.
And Ilya's, of course.
And he's here every time. But Manish had some great data and research that helped to, I think, dispel those concerns for most people. But I was surprised that it kept coming up, and people had difficulty kind of dismissing that as a concern, which maybe means we don't give it all more some thought.
Yeah, he had some interesting topics. He talked about the buy right funds as well. That's something we've been talking about in a lot of our shows. In this environment, everyone's trying to hunt for yield, and he kind of brought up the fact that everyone would assume that over the last few years, those buy right funds have been just having massive inflows. And he actually showed they've stagnated and actually lost about $8 billion over the last 3 years. So I thought it was kind of interesting. He also made an interesting point, and I was in the middle of kind of handling a couple other shows remotely and doing other things, so I didn't really catch the full glint of it. I want to go back and look at his presentation again to see if he made a point about how we view skew a little bit differently. He kind of mentioned we view investment skew for the S&P in terms of selling calls and buying puts. He actually tends to view it more in like of the buying interest in calls, which was kind of an interesting approach. And he had some data on it. Again, I have to go back and kind of really dig into his presentation a little more to see exactly what he was getting at there. But when I heard that, it kind of caught my attention, and it made me maybe want to kind of go back and look. He's always got those little nuggets. You have to kind of go back and look at his things a couple of times. Say, wait a minute, what is he talking about there? And we got a couple others, but before we do that, Ilya, I want to get you. Obviously, we're on a panel, but you obviously also saw a lot of presentations this week too, and talked to a lot of people. What caught your eye this week? What were some interesting presentations? Maybe some interesting conversations you had. What was your flavor of RMC this week?
I think there were some interesting presentations, certainly some interesting discussions. I think talking to people and seeing what people are interested in, it gives us a view of how the whole industry is right now. I think the whole industry has shifted, and this is not overnight, but gradually has shifted to one of a long asset manager. Basically, that's the focus, target audience of a lot of these strategies. And this is a manager who is gradually buying assets, holding them, and is concerned about their downside risk. So therefore is focused on, things like put writing, overwriting, and does it make sense in the overall scheme of, their portfolio. And I think that a lot of what we saw back testing, obviously, for the last 5 years. You had this upward drift. I think that environment needs to be, and that shift in the industry needs to be taken into account. Well, the price action is basically a very gradual VWAP type buying of different assets, right? That's the price action we observe intraday, intra-week. And then the question is, okay, that leads to low realized volatility, obviously, right? Because everyone's just lifting and lifting and lifting offers tick by tick by tick, which is kind of an additive rather than a geometric process. And I think we saw a lot of discussion of what could be overlaid on top of this core long position. And I think we saw many different aspects of it. Well, if you hedged, what was the best way to hedge, right? Was it to buy the VXX? Was it to buy the VIX out of the money calls? Was it to buy implied vol? Was it to buy realized vol? All right, so we saw a lot of things like that. If you were to do a 1x2 call spread, we saw some, overlaid on top of your core long position. So everything kind of revolved around, we don't want to let go of the long position. We need to manage these assets, but why don't we enhance things kind of on the edges? And my approach was a little bit different from that in that sense that I said, look, why don't we incorporate these concepts into the entire, asset allocation portfolio management process?
Yeah, it is interesting. I've been coming here, not to the California one, but just risk management in general, for a few years now. And it's interesting to see every year seems to have a theme. Last year was very aggressive in the put writing category. We saw a lot of studies coming out. It seemed like the industry collectively awakened to the notion of selling puts. One of the oldest strategies was new again. We saw some of that this year with the harvesting of risk premium. That was certainly an element to it. But as Russell alluded to, some people were out there also raising their hands to talk long premium, which is kind of interesting. Bill mentioned the capacity discussion. That came up in a couple of different scenarios. I heard it also, not just SPX, but I heard it also mentioned a couple of times. I forget the gentleman's name who was talking about it yesterday, in regards to net short Vega, net short VIX futures capacity. And a lot of people are asking, what is the capacity there? And are we perhaps at or close to that threshold? Because everyone and their mother seems like recently has been talking and writing and analyzing how about net short VIX futures interest. And how many times have we talked recently, Russell, about people actually playing in VIX puts, which is a rare occurrence in and of itself. So all this kind of combined net short VIX interest, what that means for the market. Are we at that capacity threshold, whatever that means? And that's been kind of been an interesting, I think, back and forth. I've heard a lot at the show. Also, I think one of the more interesting and or alarming slides came from our buddy Henry Schwartz over there at Trade Alert. Henry's always good for some good data, and he had some data about the product concentration in the space, which I've talked with people a few times, but to see it graphically there in your face, they say, a picture is worth 1,000 words. That was a little bit alarming to see, and listeners will include, we tweeted those out and we'll include links in the show notes so you can see them yourselves too, just how, depending on looking at premium, it's overwhelming, but even on a pure product basis, how just dominant SPX and SPY are to the overall picture. And in premium-wise, you take those two out, that's about 2/3 of the pie, and all these things that we talk about all the time, the Apples, the Googles, the Facebooks, the other things are kind of nominal in the rearview mirror compared to those, which is interesting and probably also a little alarming for anyone who's in the business, just because we want to have a vibrant liquidity ecosystem, and if everything is slowly getting concentrated into a handful of names, that is alarming for the future. Ilya, you have some thoughts on this?
Yeah, I thought that was very interesting, how everything is concentrated in the products, which are basically benchmarks. They're benchmarks for pensions, they're benchmarks for asset managers, and I think that's definitely a theme, and that's where all the liquidity is, and that's where all the systematic strategies have been focused, because there's a lot of data, there's a lot of back testing, and that's what people are comfortable with, and it can be wrapped. Another theme that came up a lot was just the steepness of the vol term structure.
Yes.
Whether it's the VIX, whether it's 3-month vol versus 1-month vol, whether it's you're selling the 1-week straddle, at 8 vol. I mean, that's kind of a theme that came up a lot, and that's what makes all of these kind of strategies where people are short the VIX ETPs and keep rolling forward, where people are kind of have other types of short gamma strategies and are doing okay with them the past 5 years, because there hasn't been really too much of a back and forth. And that is something that came up, and there's definitely some structural flow around that. I mean, there's a lot of buy writing happening, obviously. So the calls are for sale, except when the S&P makes new highs, which is a good point that was made by Manish. And there's obviously hedging as well.
Yeah, Manish, you're right. Manish made a lot of good points, and Bill brought a lot of them up already. On another panel they had yesterday, one of the panelists talked about the mean reverting nature of VIX. We've all talked about, how volatility is mean reverting. Sometimes it's overdone in the broad media, but he had an interesting graphic that showed that actually it has been accelerating over time. And I think one of the more interesting notions of that, not just the full reversion, which could take some time sometimes, but he actually also graphed out the half-life of the reversion, which is still a substantial move, and probably the lion's share of the move people are going to collect doing that type of thing. And that has dramatically accelerated. He said it was averaging, I think, somewhere around 11 trading days is what he was seeing. He was analyzing from peak to trough, so spikes like 9/11 and some of those other aberrant periods, and how quickly just VIX revert back to its mean. And so in roughly 11 days there's outliers obviously, but that really attracted me, because I was like, wow, that was certainly probably faster than a lot of people maybe would have assumed, and certainly that's an actionable, tradable element. So you can bet on the half-life of mean reversion. Who thought we'd ever be saying that before? But now you can actionably trade the half-life of VIX mean reversion. Did that catch your eye over there, Dr. VIX, as well?
Yeah, I found that pretty interesting. That's one of those things I want to go back and do a little bit of more work on. He also. I had a chance to interview him for CBOE TV, and note that he didn't have August of 2015.
Yeah, he had a couple of missing outliers there. Yeah.
But both of those were even. The August of 2015, no, the Brexit was 3 days.
Okay, wow.
Yeah, it was much shorter.
A very aggressive period at the time, yes.
So it's been getting shorter and shorter. Back to the idea behind. Do we have the capacity for the short Vega through, I know we have very high short interest in the VIX futures contracts, but we're also in pretty darn steep contango. So, somebody's buying these things, and it's holding. If we were like, what are we, about 1150 on VIX as we close today? If and I know we've got the French election off in the future, so it's up around 14 or so. But if we had, the April futures down at like 1250 or something that we weren't, something really flat with a low VIX, then I might start to buy the argument that we're starting to reach a capacity issue. But the fact that we've been in a fairly steep contango for most of 2017 leads me to believe that there's more room for people to take down the short volatility.
Bill, I know you like watching the VIX futures quite a bit. You may sling one or two over there in Luby Asset Management. What are your thoughts on, you mentioned the SPX capacity, but what about short VIX capacity? And did that catch your eye? And are we floating perhaps near those levels?
It did, and I thought it was interesting. I can't remember which presentation it was, but I believe there was consensus among those on stage presenting that the capacity is growing and the need for the capacity is reasonably flat. So with each passing month or quarter, or however you're measuring this problem, it becomes less and less of an issue. So I thought that was interesting. Also, just a quick comment on the steepness of the contango. People are starting to get used to a VIX of 10 or 11, so you do see the curve starting to flatten pretty substantially from the mid months out. So you see, from months say 3 to 4 out to the back months. You do see a lot of flattening over the last couple of weeks, where people are starting to think, this may be here for a while.
Yeah, you're right. It has people are maybe settling into this notion. The steepness of the curve has certainly mitigated. I also saw an interesting presentation this morning. Scott Maydell, he's been on the show a number of times, formerly of Russell. He's kind of my go-to guy for a lot of data on the weeklies. He's one of the first people I saw, I think, to really put together some numbers back when the weeklies were exploding about premium harvesting in the weeklies and aggregate weeklies versus monthlies versus annual. Now we see a lot of that, but he was one of the first guys I saw to really, I think, do a lot of hard numbers on that. And he had a presentation with some others this morning as well, kind of talking about different areas of the weeklies and kind of getting back to that point made earlier about how everything has kind of been focused around a lot of it has been focused around the premium harvesting equation or the risk premium harvesting equation. He made an interesting allusion that at the start of his talk, saying clearly all of this aggressive risk premium harvesting has impacted the volatility skew of these weeklies, and he kind of commented, and something I've noted as well, there hasn't been a lot of research really done yet into what that means for writing these things. Clearly the amount of premium you're getting for writing these over time has come in. He said his last big study was 2013 or so in that time frame these things are not quite as rich, as juicy as they were when people were first discovering this notion of writing. I think they might be interesting, and he kind of alluded to it later in his presentation as well, that maybe there are some perhaps opportunities for selective, let's say not selling at the very least, as opposed to buying. But we are getting to the point, we've talked about on this program before, intra-week perhaps buying of weeklies when they are overdone, perhaps getting into a weekend and kind of getting some of that free weekend risk. In fact, getting back to what you were saying earlier, Russell, about Trump and the weekend risk, our friends over there at Rex Shears, who were on the show a few weeks ago, they sent me this right before the show. Yeah. This is, I guess, this is from our big reliable source, Vanity Fair, but we often quote them on the show. But they apparently did some research into Trump's tweeting patterns, and they've discovered what they term the Sabbath effect, the Trump Sabbath effect, which is he has some advisors who are observant Jews, and it's been noted that the frequency of his, shall we say, more market-moving tweets is increased in that period from Friday evening to Saturday evening. In fact, they have some data here. If I can just pull it up. I think they actually break it down in some interesting ways. If I could find it, like the number of tweets with multiple exclamation points is 23% higher during that time frame than some other kind of silly data points. But that silliness of the data aside, it does bring up an interesting thought process. We obviously have a president who could move markets on a whim, move companies on a whim, has been shown to do just that time and again. We have seen a lot of these events that have so far occurred in the early part of his administration have taken place over the weekends, the announcements and things like that. So it does kind of raise the question of perhaps there are some opportunities here for some selective hedging using the weeklies, some selective buying to take advantage of. Certainly not selling them going into a weekend. We know there's weekend risk now that is demonstrable. I don't know, Russell, I see you laughing over there. Have you had a chance to see some of this research?
They asked me to retweet it for them, so I looked at it a little bit earlier. And I love the guys over there. I really do. This is pretty funny, though. It's basically when Ivanka is not around yes. to smack the BlackBerry or whatever out of Donald's hand, he is more likely to tweet something that might be controversial, because during the Sabbath she and her husband are absent from keeping a handle on him. Gosh, do I like to avoid politics, but I really wish that his whole family was with him all the time, because I do believe they're the only ones that can talk a little sense into him. And the fact that he's only got one of them around right now, and his sons are back in New York running his company, I wish they would let them all be with him all the time, and hopefully calming down a little bit on the tweeting.
Here's some of the data points here. His tweets during those Sabbath hours have 17% more exclamation points. This is actually to Slate, not Vanity Fair, Slate. And 29% more pairs of consecutive capital letters. So there you go. It's kind of silly, but Ilya, same question to you. Is this kind of bringing up some ideas about, we've heard so much about harvesting risk premium. Maybe there are times when, at the very least, maybe you shouldn't be harvesting that risk premium. Maybe you should keep something in your back pocket for the literal weekend risk, call it the Trump risk, whatever you want to call it these days. Is that something that's starting to interest you? Are you starting to hear that from your clients? Is this something that's starting to concern you over there at Wallachbeth? Maybe some selective opportunities where you should ease back on the harvesting and perhaps even, horror of horrors, buy some premium? I hope Don Schlesinger isn't listening. I just made him very upset right now.
There's definitely, opportunities now where you're not selling premium. Maybe you're doing a spread or you're putting in a little bit of premium because the realized vol is low. But there's some edge, and we looked at things like these butterflies, ratio spreads. Selling a put spread, buying a call. If you're bearish, you can do a delta neutral. I mean, there's other strategies that have been interesting, other than just being short gamma, and certainly going into weekends, I would say more of that risk is single stack related, and that's one of the reasons that implied correlation has been so low. As you remember, something I pointed out in my presentation, they pumped up that implied correlation to very high levels into the election, and now I think they've taken it down to very low levels, and part of the reason is this risk in single stacks. And one macro thing also we've observed is, we've had kind of a bullish move, but there's certain sectors of the economy that haven't been doing that well, like the consumer. We've had a lot of misses. We've had a lot of credit events, and that's an area where it's been very difficult and dangerous to be short premium. And that sector is also exposed to some of this border tax situation, as well as whatever happens to things like minimum wages and, labor, dislocations internally versus externally. And it's also having its lunch eaten by Amazon and online. So we've seen a lot of risk in that sector, whether it's XRT or some of the names. And so those have been making very big moves, whereas the overall market's been very tame with this, VWAP buying. And yeah, definitely I think each environment has its own kind of go-to sectors and its own kind of tail risk sectors. And, I think right now the consumer, non-internet consumer is a place where there's some huge movement in the underlying stocks, and you don't really want to be short gamma.
Bill, you're our resident money manager here today. What are your thoughts on this, the notion of weekend risk maybe exacerbated under the Trump era, and how this correlates to what we're talking about here about harvesting or perhaps not harvesting all that juicy, or perhaps less juicy these days, weekly risk premium?
Yeah, I think so. I haven't run any numbers yet, but the whole idea of the dampening of volatility during the Friday as people start to mark down their weekend expectations, and you can see the changes in the VIX versus the VIX front month future. Typically on Fridays, as the VIX tends to fall faster than the futures, or has a directional bias downward relative to the futures, I think that may start to go away. And while most of the tweets so far have been impacting single stocks, I'll be shocked if we don't see some that have pretty significant macro events. I mean,
this market is overbought! Exclamation point! Exclamation point!
Yeah, or whatever it is. But there are so many places around the world that can be touch points for a tweet that hits it. So I think we're going to see some changes along those lines, and a lot of the stuff is going to happen over the weekend. And at some point, we're going to have to start pricing in some Trump tweet premium that it's funny. I was thinking about, ironically, the fact that he tweets a lot may get people desensitized. If this stuff only came out at a news conference every 6 weeks, people might panic. But if they hear it every week, it's like, oh, it's just Trump being Trump.
That's true.
So I'm not sure whether there's a desensitization factor in here, or whether that's going to be plus or minus. But I do think that we're not going to see this volatility much longer in 2017.
It's 5 a.m. It's Trump tweet time.
One thing I wanted to add about Fridays is, one of the Fridays is the employment report. And one of the things that's been going on is it hasn't really been that important, because if it prints a little bit lower now, it's not going to really change the Fed that much. If it prints a little bit higher but wages aren't going up, it also doesn't change the Fed's view that much. The Fed talk actually has been more important than the actual employment numbers. So one of the big Fridays, you've really eliminated the moves, and you've seen the moves have been very tame, and the implied moves have also come down on average. So that's a big factor also on Friday you can't ignore.
Yes, non-farms used to be, obviously you're right, used to be a big driver. Less so these days. It had a little bit of a spark there when they had a couple surprises. People started paying attention to it again for a few months there, but it seems like you're right. Non-farms certainly not the market mover that it used to be. I want to get back to something you were saying before, Ilya, which is kind of interesting, which is something we've been debating on this show for a while. People have been writing in, certainly for the last few months. Why is realized vol so low? Why is vol? Getting back to you were saying before earlier, Russell. Why, just in general, why is vol so low? And one of the points you brought up, and then was brought up on one of the panels this week too, is one of the big dampeners on vol has been that realized correlation amongst the different sectors has also taken it on the chin, to use the technical term. And that's been kind of interesting in and of itself. Not a factor we typically discuss here on this program. And you've been talking a little bit about correlation recently, soon to be Dr. Vix. You've been talking about more SPX and VIX correlation, but has this lack of correlation amongst the sectors, has this been filtering into your correlation research? And are you buying what they're selling here, that this lack of correlation is accreting into lower realized vol as a result?
Yeah, it's a different sector leading every day, which is just kind of the if you look at I think it's the 11 industry-oriented ETFs that you can kind of get an idea of who's leading and who's lagging from day to day as we grind higher. It seems like there's a lot of rotation going on there, so which means that different leaders each day, a little bit more dispersion among who the winners and losers are each day, but they all seem to be moving in the same direction. And because of that, that's just another reason that you're seeing lower volatility, as measured by VIX and low, the lowest realized volatility I think most of us have seen in our lifetime with respect to the S&P 500.
Yeah, we do have, I'll go around each of you and get some of your final thoughts here. And then if we have time, maybe have a couple questions people asked us about specific RMC things, so we'll get to those. Maybe, Ilya, we'll start with you. Any final thoughts or ideas or takeaways you have from the conference or that you want to leave our listeners with as they're listening to this and thinking about the conference?
I think the sophistication of the users of options continues to grow. I think the evolution into risk, thinking about things in terms of risk premium, thinking about systematic strategies, and I think that's going to continue to evolve. And I think what we've seen is that people are looking for more sophisticated ways of looking at things. And what I'd like to see more is incorporating these concepts into the overall portfolio management, not just a single option strategy. I think that will come eventually as people, continue to grow more familiar with these strategies, have some positive experiences with them, whether it's, doing things like adding income or protecting the downside, or maybe being a little more proactive and taking some of their long risk in options. I think that that's a growing thing. But there are also a lot of pitfalls. That's what I mentioned in my presentation. Is you can't really look at these back tests. On the surface, you got to really dig deep down into what these things can do. And a lot of what's been going on has been, very environment dependent. We're in a very specific environment where certain things are working well and, others are not.
And actually, before you switch off, just because we're running up against it here, maybe we might as well do this now as well. Ilya, and if people liked hearing about your presentation, if they like hearing about what you're talking about here, where should people go to contact you, reach out to you? Maybe they want you to help them adjust their portfolio, something along those lines. Where should they go? What should they do if they want to reach out to you and the team at Wallachbeth?
They can certainly look at our website, wallachbeth.com, all one word. They can email me. It's just Feygin, Ifeygin, @wallachbeth.com. That's probably the best way.
Wallachbeth is WALLACHBETH, correct?
All one word.
Wallachbeth.com. There you go, listeners. You can reach out to him and put Ilya into work for you. Same question for you there, Mr. Rhodes. This is kind of, like I said, this is one of your big active weeks. It's kind of hard probably for you to summarize all of it in a few minutes. I'm going to make you do it anyway. What are your final takeaways here from this year's U.S. version of RMC?
Well, just we've all mentioned a lot of things already, but something that didn't get brought up was the dispersion of the attendees. We had more advisors. We even had some pretty sophisticated retail traders here that
quite a few
you mentioned to me.
Retail here, yes.
But Scott Medell said that he saw a lot more consultants and a lot more advisors who 3-4 years ago would have been scared by half of the presentations here, but are most definitely now kind of open to either something that's focused on trying to harvest volatility or using some sort of consistent option-related strategy or just trying to figure out how to protect their portfolio as the market's at highs. So, I think that the crowd that we had, really smart, but it wasn't the geek prom that it's been in the past, where it's just been a bunch of people like Bill and like us. It seems like that we're becoming maybe a more mainstream conference.
It was surprising to me how many active retail I did encounter here who were very conversant, fluent in the show, which was fantastic. In fact, this show, I love coming out to this conference because so much of our audience is here. I have so many people coming up to me, asking me questions at lunch, at dinner, at the receptions about specific episodes. They were versed on conversations we had about, let's say, the 30 strikes, or about some of the other topics we talked about many times, and agreeing or disagreeing or having their own thoughts on what we should talk about or who we should bring. I love hearing that from people. I love hearing that they're so invested in the show. So I love coming out to I almost said to Volatility Views. It's kind of like that, though. Coming out to RMC because so much of our audience, institutional, retail, they're all here. So we love meeting you guys. If you're going to be in Florida next week, not a lot of some of you might be over at the FIA show. Feel free to reach out to me. I get a lot of that at these events when I hear people. I walk by people and they don't know my face because it's radio, but they hear the voice, and then they turn around and say, "Wait a minute, you sound like the guy who does those shows." And so I get a lot of that, which is always kind of funny at the end of the day. Bill, last but not least here, you come to RMC quite a bit. What are your thoughts on this year? Some takeaways, some interesting themes, maybe some surprises, and do you take umbrage at Russell's slam on you?
Not at all. Actually, it's kind of a tangent from what Russell just said about the rise of the retail investor in the space, and also, and I won't call them unsophisticated, but maybe some newer money and systematic strategies on an institutional level that are coming into the space. And when we've been hearing about the search for yield for the last couple of years, and the buy rights and the put rights, et cetera. But when you have a lot of systematic new money and volatility strategies, and you have a VIX of 10 and a VIX of 11, and you have a lot of uncertainty, and you saw what happened when the VIX went from 12 to 53 in, a day and a half? So I think the next spike is going to catch a lot of people offside, and the systematic volatility strategies better have some sort of defined risk in them. And I think that this, while the mean reversions are getting faster, that also probably means that when these people get caught off sides, expecting the mean reversion to happen, and it doesn't, that we may see some really larger spikes than we've seen in the past.
Yeah, it has been interesting. We've talked many times on this show over the last year probably about all the different ways we see people trying to capture that spike, usually the short one and long two. I heard an interesting variation on that one of the panels this week. I think he was short 3 and then long 2 and long 2. It was a funky tree. I forgot how many legs of 2 he was long, but at least 2 or at least 3. So yeah, it was like a short 3, long 6 maybe, and with some strike discrepancies. So playing on that short 1, long 2 kind of thing, which I thought was kind of interesting. A little bit of a VIX tree there. So we'll have to dig into that maybe on a future show. But you're right, there's a lot of interesting things. Certainly a great conference. I encourage listeners. One of the great things you guys do at CBOE here, Russell, which I love, I wish more conferences did that, is you release the lion's share, not all of them, but the lion's share of the presentations via the app. So listeners, if you couldn't make it out for whatever reason, check out the show. Hopefully we did a good rundown. Check out our tweets from the show. We have a lot of good little nuggets there for you. And hopefully you can make it out to a future event either here or there's one coming up, I believe, in you have Hong Kong, you have London, you have a number of different places. Search for CBOE RMC and you will find it. And on behalf of Ilya and Russell and Bill and indeed myself, I want to thank all of you out here in the listening audience for downloading, streaming, subscribing, including all of you who came up to us this week of the show. We love talking to you guys, and we'll see you next week for more Volatility Views.
Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.